This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rally mode. The blue chip Dow index sizzles and hits an all-time high as the hottest sector of the year cools off to start the second half.
Summer slowdown. Auto sales slam the brakes as buyers turn away from high prices.
Open house. It's a seller's market with not much for buyers to choose from. But could that change in the months ahead? Those stories and more tonight on Nightly Business Report for Monday, July 3rd. Good evening, everybody, and welcome. Wall Street was turned inside out today. The Dow, the world's best-known market index, was in rally mode, hitting a record midday on this holiday shortened trading session. Leading the charge was the energy sector, which was the worst-performing group for the first half of the year. The one sector that did not participate in the rally today was the technology sector, the best performing sector during the first 6 months of the year. Here are the closing numbers for you. The blue chip index advanced 129 points to 21,479. The NASDAQ dropped 30. S&P 500 added 5. Also helping the climb today, the transportation sector, which hit a record. That group is considered a key part of the market and the economy. And Morgan Brennan tells us where it may be headed next.
The Dow Transports recently reversed course to outperform the broader market. Today was no exception, as the Dow Jones Transportation Average hit a new high, flashing a Dow theory buy signal that means stocks could continue to gain ground. And analysts expect the strength in transports to continue, at least for now. Improving data, stronger economic growth, a weak dollar, and the unrelenting rise of e-commerce should all bode well for companies hauling goods. UPS and FedEx will once again juggle a record number of packages this holiday season. Both are investing billions to do so, and UPS has announced a new charge, with FedEx expected to follow suit. Trucking has begun to bounce back, and a big rule taking effect at year's end will force carriers to electronically track driver hours. That should help rates, since it will take some capacity off the road. But the big wild card could be rail stocks. After CSX, Norfolk Southern, Kansas City Southern, and Union Pacific all chugged higher in the first half of the year. They'll face tougher volume comparisons, especially since key growth areas like autos have started to wane. A big factor that could derail the group, energy production, which, as oil prices plunge, could begin to decline, putting pressure on demand for many of the industrial products and materials the railroads move. For Nightly Business Report, I'm Morgan Brennan.
Corporate America also getting ready to report quarterly results over the weeks ahead. And as always, Bob Pisani says those earnings will be a key driver of stock prices.
Second quarter earnings season starts in less than 2 weeks, and the early signs are we might be in for a positive surprise. It's early, I know, only 23 companies, about 5% of the S&P have reported earnings for the second quarter, but the results from the early reporters like Nike, Oracle, and Darden have been surprisingly strong. Earnings for those 23 companies are up 12% from the second quarter last year, continuing a rebound that began a year ago. But the big story is revenues. They're up about 8%. That's important because skeptics have argued for years that earnings growth is coming mostly from cost cutting and stock buybacks rather than from real revenue growth. That's not the case anymore. It takes away a major argument for the bears. But 5% is a very small sample. What about the other 95% they haven't reported yet? Analysts are traditionally optimistic, you know that, and estimates usually come down as we get close to the quarter. But this time, estimates for the other companies are not being reduced nearly as much as in the prior quarter. And more than 40% are seeing estimates increase for the third quarter, not decrease. That's unusual. This implies that companies are very comfortable with their earnings estimates right now. Otherwise, they'd be cutting the numbers much more aggressively. Now, earnings season doesn't really start until July 14th when J.P. Morgan and Wells Fargo report. But even though it's a small sample, we're off to a strong start. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And as Bob just mentioned, the markets ended the first half of the year on a strong note, with all three of the major indexes posting gains. But can the run-up in stocks continue through the second half of 2017? Here to discuss both sides is Peter Mallouk. He is President and Chief Investment Officer of Creative Planning. He's bullish on the market. And Eric Anes, who is the President of Titus Wealth Management. He's a bit more cautious. Gentlemen, welcome to both of you. Nice to have you here. Eric, I'm going to start with you. What makes you a little bit more cautious on this market?
Well, first I'd like to acknowledge as we come up to July 4th, what a wonderful 8 years we've had in this bull market and U.S. markets. It's really a wonderful thing to see. That being said, we're watching a couple things, in particular some technical analysis and some fundamental. When we look on the technical side, we look at the volatility index, which has been at all-time lows. Oftentimes when it hits lows like around 10, we see volatility spike up. The other is on the fundamental side, the technology index, the SOX index, which is mid-June, it was 155. Now it's 138, so off about 10%. So we're just a little more cautious because we've seen a little bit of a pullback in technology and a few of the other contrarian indicators.
So, Peter, Eric says that optimism is high, volatility is low, and that concerns him. Does it worry you?
No, not at all. And I really don't look at those things and really don't factor in the technical component into our investment decisions pretty much at all. The way we look at it is from a very big picture level. If you look at what drives markets, it's like Pisani was saying earlier, it's future earnings. And right now, investors are seeing, hey, it looks like these companies are going to make a lot of money. And what drives earnings? One of the biggest factors is unemployment being low because people are working and they can go buy things. And we have unemployment at more than 10-year lows. So you have a lot of people going back to work. You're starting to see wage inflation. And of course, that means people feel better about the market because companies' earnings are growing. And so I don't see anything that tells me that that's going to change, especially in an environment where the 10-year Treasury, the alternative investment option is less than 2.5%.
Eric, a question about the pullback in the technology sector that you mentioned. Differentiate for me a pullback that you find somewhat worrisome versus simply a rotation out of those stocks which have had such a big first half.
I'm glad to do that. But first, let me kind of address the wage, unemployment and wage growth. What we've seen, and the Fed chairman said this a few weeks ago, that wage growth has been very sluggish. So the question still remains as to what type of jobs are really being created out there. So you really want to kind of make sure you watch for that. And markets are forward-looking. So the question is, we're coming into a seasonally slower period of time, which is the summer. Markets are forward-looking. So we do want to say, and as I like to say, I'm not a complete bear, but I'm cautiously optimistic from that perspective.
So, Peter, let me push back just a little bit on a couple of points there. I take your point that you're not worried about optimism or necessarily about the lack of volatility, but equity prices are at somewhat extended levels. That's number one. Number two, interest rates are likely to rise over the rest of the year. At least the Fed has signaled that they intend to do that. We'll find out, obviously. And then third, the economy is not exactly tearing it up, and the Trump agenda seems to face a lot of headwinds. If some of those things materialize, what could happen?
Well, the thing, Tyler, about everything you said, except for the Trump part, we could have said in 2008, 9, 10, 11, 12, all the way up until this year. Interest rates are likely to rise, and earnings...
Well, for a lot of that time, interest rates weren't likely to rise.
Well, I think that if you looked at what economists were predicting each year, they were predicting they would rise. I think the Fed is going to increase rates, and they have. But if you look at the 10-year Treasury, it remains very low. We have to look at the difference between the valuation of the stock market and what the 10-year Treasury is offering. To your point about slow growth, my answer would be, yeah, it'd be great to have unemployment drop quicker and wages rise faster and growth to grow faster. But we've been in a period of slow growth for 10 years, and that's okay. It's not optimal, but it's heading in the right direction. And so to me, I'm looking at, hey, if unemployment's going to go down slowly, if earnings are going to go up slowly, these to me are not things that say get out of the market quickly or even take a defensive posture. I mean, we're looking at the market has an upward bias. It's up 3 out of 4 years. I don't think a forward PE ratio of 19 is a reason to go running for the sidelines.
Very quickly, Eric, if you are somewhat defensive on this market, where are you putting money to work?
As I like to say, toilet paper and toothpaste. So defensive names along those fronts. And obviously, we feel that financials are undervalued, and they could definitely benefit from a rise in rates as we kind of move into that next phase of rate increases.
All right, gentlemen, thank you very much. Eric Anas with Titus Wealth Management and Peter Mallouk with Creative Planning.
American manufacturers growing now at the fastest pace in almost 3 years. The Institute for Supply Management said its index rose more than expected thanks to improved economic conditions, both domestically and abroad. New orders and production rose sharply, and employment plans hit the second highest level since 2011.
Summer is traditionally the busiest season of the year for auto sales, but this year dealerships are seeing fewer customers. The pace of sales is expected to be under 17 million vehicles for the fourth straight month. Phil LeBeau has more on the slowdown in sales.
The signs of the season are out at dealerships. There's plenty for sale, but not as many customers as dealers would like. Compared to June of last year, sales last month were not terribly impressive for the 4 largest automakers in the U.S. But the average price being paid for a new model, over $34,000, continues to tick slightly higher. So consumers are still spending, especially on trucks and SUVs. But automakers have gradually seen inventories rise as sales have eased. As a result, some assembly lines are stopping production for longer than usual this summer. But not Tesla, where the electric automaker's production of its new Model 3 will start later this week, with the first Model 3s being delivered later this month. It has an expected starting price of roughly $35,000. The Model 3 is targeted at the mass market and is critical to Tesla taking the next step and becoming more than a niche automaker. If initial reviews of the Model 3 are positive, don't be surprised if we see a surge in reservations, which already stand at well over 300,000. Phil LeBeau, Nightly Business Report, Chicago.
Iran signed a $5 billion agreement with France's Total and a Chinese oil company to develop an offshore natural gas field. This is the first such deal with foreign companies since the country's 2015 nuclear deal with world powers. Iran shares that offshore field with Qatar, which is now in the middle of a diplomatic row with a number of other Arab states. Total's chairman said the project will be developed in strict compliance with national and international laws.
Oil prices rose for an 8th straight session, their longest rally in more than 5 years. This comes after new data pointed to moderating U.S. output. But according to a new survey, only a few see prices climbing even further. Jackie DeAngelis has more.
Crude surprised everyone in the first half, logging a near 15% decline. That's after having touched bear market territory. If the second half sees declines, crude could see its 3rd down year out of the last 4. So where do we go from here? CNBC's exclusive oil survey polled analysts, traders, hedge funds to get their take. Survey respondents largely agreed that there could be more price pressure. How low can we go? Most said the high 30s, but there are others who see crude prices closing the year between $40 and $49 a barrel. When asked about OPEC's attempts to limit supply to increase prices, the majority said the cartel will flex its muscles to try to support the market, but that OPEC has lost control of prices. Meantime, almost everyone said supply is still the most important factor influencing prices, and 80% said that will continue going forward. With respect to demand, about half said it's trending stronger, but not strong enough to absorb excess product. Finally, 60% said President Trump's pro-energy policies were not having a direct impact on price at this time. Overall, a bearish view on crude. For Nightly Business Report, I'm Jackie DeAngelis.
Still ahead, challenging market. Home buyers are having a hard time, prices up, inventories low. But could market conditions ease later in the year?
Big Pharma is turning to artificial intelligence to find new medicines. Over the weekend, GlaxoSmithKline said it was investing more than $40 million in a new tie-up with a privately held company that would use supercomputers to predict which drugs are likely to be effective, saving time and money on unnecessary tests. Merck, Johnson & Johnson, and Sanofi are also looking into artificial intelligence to help streamline the drug discovery process.
Well, with the Senate health care bill now apparently in limbo, lawmakers are back in their districts now, or states, talking to constituents about where things stand, and a lot of questions remain. John Harwood is not off today. He's with us tonight. Congress out, John, on that July 4th recess. What does it mean for repeal and replace?
It means they've got a lot of work to do, Tyler. I spoke to a Republican strategist familiar with Mitch McConnell's thinking. He said there's about a 1 in 5 chance that they can ultimately get the votes, but when they decided not to vote before the July 4th recess, it signaled how far short they were of getting the 50 votes that they need in order to get Mike Pence to break a tie and pass this bill.
And to that point, Senate Leader McConnell faced objections from both conservatives like Rand Paul and moderates like Susan Collins. How does he walk that line?
Not easily, but it appears that they've decided that the way to victory is to try to go left. They're not going to go further right. They believe that Rand Paul, who's a libertarian, is simply not a gettable vote. They're hoping that other conservatives like Ted Cruz and Mike Lee of Utah are ultimately not going to shrink, even if they don't like aspects of the bill, from taking their last best chance to substantially overhaul Obamacare. On the left, what they're trying to do is figure out ways to defer or retain some of the Obamacare taxes so that they'll have more money to play with to increase funding for things like opioid addiction treatment and also for Medicaid, which is a big concern for people in states like Ohio and West Virginia and Alaska.
Let's assume that the Senate manages to pass a bill. It tilts a little lefter than it's been. What's the reaction likely to be in the House? Will they just take it or what?
Well, that's a very tough decision for the House, because I think if you start to get a Senate bill that retains some of the Obamacare tax increases, then it becomes much more difficult for the House to simply take the Senate bill and send it to President Trump for his signature. But Paul Ryan has been talking about this for a long time. Like Mitch McConnell, he wants to get this off his plate and get to tax reform. So that would be a hard decision for him. If they had passed the original version of the Senate bill, I think that House within days would have passed it, put it on President Trump's desk. Much dicier now.
Yeah. How long do you think they will let this debate go on? And do you think that they actually come up with a bill?
Well, the source familiar with McConnell's thinking told me that no later than July 21st, July 21st, after the 4th of July break, they do not want to come back after the August recess and have to deal with this. They want to be on tax reform. And if they pass it by July 21st, then you've got one more week for the House to act before the break.
All right, John, thanks very much. Have a good 4th of July. John Harwood.
You too.
In Washington.
EQT's proposed takeover of Rice Energy hits a snag, and that's where we begin tonight's market focus. The Wall Street Journal says activist hedge fund JANA Partners took a 5% stake in EQT in an attempt to block its nearly $7 billion merger with Rice. JANA thinks the price of that deal is too high, and it would rather see EQT separate its pipeline operations. Shares of EQT rose 2% to $59.75, while shares of Rice Energy fell more than 3% to $25.66. Caterpillar reportedly did not submit the necessary paperwork to the government in recent years regarding that company's exports. It's part of an ongoing criminal investigation into suspected tax evasion at the equipment giant. The Wall Street Journal says federal investigators have also uncovered discrepancies between Caterpillar's regular filings and in what it previously gave to authorities. The report adds that the findings are preliminary. Shares of Caterpillar were off 0.5% to 106.97. And NASCAR racetrack owner International Speedway said it expects dividends to increase by about 4 to 5% in 2018. But that news was overshadowed by the company's lower than expected earnings and revenue. And investors put the brakes on, sending shares down 5% to $35.60.
The Canada-based oil producer Suncor Energy reportedly will not reinvest in its core business anytime soon. The Wall Street Journal says the company, which focuses on mining oil sands, will instead give investors the excess cash it makes in the coming years. And shares were up 2.5% today. They finished at $29.94. The personal finance website Bankrate is being bought by the digital marketing company Red Ventures for more than $1 billion. Red Ventures will pay $14 a share and will use the deal to expand its presence in the financial services industry. Bankrate up 8.5% to $13.95. General Electric has officially completed its nearly $7.5 billion deal to combine its energy unit with Baker Hughes, creating one of the world's largest oil field service providers. The company will be named Baker Hughes, a GE company, and will trade on the New York Stock Exchange under the ticker BHGE on Wednesday.
Well, if you're a homeowner or looking to buy a home, you probably know that prices continued to rise in the first half as the number of houses on the market fell. It was a simple supply-demand equation. But will the same story carry through for the rest of the year? Diana Olick takes a look.
A lack of home listings has been the lead story in the first half of this year, keeping home sales at a slower pace than expected, especially on the lower end of the market. Take a look. Sales of homes priced below $100,000 are way down, and those below $250,000 are barely ahead. The higher end of the market is seeing a big jump in sales, but only because there are more listings and buyers are less cash strapped. This is unlikely to change in the second half, even as seasonal demand falls off. But it's a great opportunity for the nation's home builders if they start putting up cheaper homes, which they claim they will do. Builders are also hoping for deregulation under the Trump administration. Tough regulation now accounts for 1/4 of the cost of putting up each home. The possibility of deregulation this year, coupled with the tight supply of existing homes for sale and low mortgage rates, has had the homebuilder stocks on a tear in the first half and could continue into the second. And don't forget the remodeling market, which is also getting a huge boost from the lack of homes for sale. Home Depot, Masco, all names benefiting from that. When people can't move, they remodel and upgrade older systems. As for the elephant in the room, mortgage rates, we keep predicting they'll go up, and no, they haven't yet. But with the Federal Reserve continuing to pull money out of the mortgage bond market, there will be more competition for cash, so rates will have to move higher. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, heading to the beach, you first might want to see if your state passed its budget. The world's biggest casino hub saw revenues rise sharply in June. Macau said revenue rebounded after a more than 2-year tumble as demand from high roller VIPs accelerated, despite a corruption crackdown by the Chinese government. Macau is the only place in that country where gambling is legal.
Well, you may have noticed a change to your credit score. As of July 1st, all civil judgments and some tax liens will be removed from credit reports. This is a result of policy changes at the 3 major credit bureaus, and we told you about it. The changes are estimated to benefit between 12 and 20 million people, resulting in a credit score increase of up to 20 points.
Tax changes in a number of states also went into effect on July 1st, the start of the fiscal year for many. Here's a look at a few of them. According to the Tax Foundation, Indiana has the only corporate income tax change, with the rate decreasing to 6%. Individuals in Kansas will see their income tax rates rise. Tennessee reducing its sales tax rate on groceries. And 6 states, Indiana, Montana, New Jersey, South Carolina, Tennessee, and West Virginia, have increased their gas tax rates.
The Illinois House of Representatives passed a final budget bill which approves $6 billion of bonds to pay prior bills. It also approved a $5 billion income tax increase and a spending bill over the weekend. Now, the budget implementation bill now gets sent to the Senate. The cash-strapped state began an unprecedented 3rd straight fiscal year on Saturday without a complete budget. As we reported, the inability of Illinois to approve a budget has put the state on the verge of having its debt downgraded to junk.
And Illinois isn't alone. 11 states did not have budgets in place on July 1st when the fiscal year started in most places. Maine's partial government shutdown entered its 3rd day today, but there is some movement. A budget panel reached a late agreement on Sunday. In Wisconsin, the sticking point is over how to pay for needed road repairs. And in Connecticut, the governor is funding the state by executive order. The good news there, public beaches in that state are open. But the same is not true in New Jersey, where there are a number of places that are now off limits to visitors, even during this popular vacation time. Kate Rogers is in Liberty State Park in Jersey City, New Jersey.
If you were looking to hit a state park or beach this holiday weekend in New Jersey, you're out of luck. That's because more than 50 beaches, parks, historical sites, and recreational areas like Liberty State Park are currently closed to the public. This is due to the state government closing down at midnight this past Friday as Governor Chris Christie and the Democratic-led New Jersey State Assembly failed to reach a budget agreement. Despite parks and beaches being closed, the governor did find himself on a beach this weekend at Island State Park. Even though it's closed to the public, the governor's office does have a residence there. Some agencies will remain open, including New Jersey State Police, state hospitals, New Jersey Transit, the lottery, casinos, and racetracks. New Jersey residents not pleased to hear about the state park and beach closures.
Outrageous. I mean, everybody knew this was coming. Everybody knew there's a July 4th weekend where people want to go to the parks. That's what they're there for. And not to have that available, there's just no excuse for it.
I'm stunned that the legislature, coupled with our governor, can't figure it out. And that he can go to the beach and the rest of us can't. That was one of our plans, was to go to the beach, go to the park at the north end, right? And we can't do that. They ought to be able to get to it.
New Jersey is just one of many states facing a budget impasse and reduced services to start the fiscal year. Residents are eager that both sides will work things out soon. For Nightly Business Report, I'm Kate Rogers in Jersey City, New Jersey.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Matheson. Have a great evening, everybody. Happy 4th of July. We'll see you tomorrow for a special edition of NBR.